Today, I'll be briefly breaking down my choice for the top 3 high-yield Canadian dividend stocks. I've done this video a few times in the past, but as the market slump continues into 2023, sometimes investors are too scared to invest or just want some reassurance. I'll do another video maybe next week about the top 4 high-yield US stocks if you're interested as well. Before I get started, if you're a beginner investor or new to Canadian finance, I've created a course for you called Canadian Finance Pro. It's over 8 hours long. It's almost 60 videos where I discuss budgeting, credit, inflation, managing debt, where to invest, and how to invest for beginners. For the next few weeks, I'm offering 30% off. You can use the link I've provided. There are probably 50 stocks to choose from. My current criteria for this video are as follows. Stock price has been beaten down, history of increasing dividends, and lastly, I believe there will be a recovery once the recession is over, which is a funny thing to say because a lot of experts are saying the recession hasn't even started, which is fine. Full disclosure, I have invested in these in the past, but I do not invest in them now. I'm a full-time options trader. I do not own any growth stocks or dividend stocks. I can make more trading options. With that out of the way, let's start with our first recommendation, Bank of Nova Scotia, ticker symbol BNS, trading on both the Toronto and New York Stock Exchange. So just make sure you know which currency you're buying in. BNS is currently trading at $65 per share, down almost 28% in the year, and pays a dividend of $4.12 per year per share, which is just over 6%. It's an amazing yield for such a safe stock and a safe dividend. The dividend is quarterly and they've increased it 11% in 2021 and another respectable 3% in 2022. This is a buy and hold forever type of stock. So if you don't need the dividends right away, I would enroll in a DRIP where you reinvest the dividends into the stock to get more dividends. You would need around 4,400 invested to get enough dividends to reinvest into 1 share per quarter. The PE ratio, which is a useful metric to measure bank stocks, is 8.16, which means it will take 8 years to make back your investment in theory. The average for the TSX is 14.5. Although this metric isn't perfect, it shouldn't be your only judge of a stock, but it might imply BNS stock has room to grow. It might imply that it's undervalued right now. So this meets all my criteria to make the video. If we look at their peers, RBC and TD, which are only down 6% and 12% in 2022, Scotiabank has added international exposure in Mexico, Peru, and Chile, which is causing the added pressure on the stock. But I do believe these troubles are temporary and it is probably the best Canadian bank stock to hold during a recession. Next on the list is Bell Canada, ticker BCE on the Toronto Stock Exchange. They're currently trading at $60 per share and they pay a quarterly dividend with an annual yield of 6.03%. I chose Bell over Rogers and Telus specifically for the dividend yield. I was looking at all 3 stocks to pay over 6%. Rogers is at 3%, Telus is at 5%. It might not seem like a value play right now with the PE ratio at 19, but it appears to be in line with its peers, all 3 telecom companies trading above the average TSX PE ratio. This is a good long-term dividend stock also because of its past performance, specifically in increasing their dividends over the last 13 years. They've had an average 5% increase in dividends every year. This is a strong contender for the buy and hold forever type of stock. If you don't need the dividends right away, again, I recommend enrolling in a DRIP. You would need around 4,100 invested in BCE to earn enough dividends to get 1 reinvested dividend per quarter. I believe their earnings will be positive and their guidance will remain high for a few years, but this might experience some turbulence when it comes time to renew their debt. Right now, Bell Canada has around 85% of their debt in fixed rates, which is amazing. The Treasury or Management Department anticipated higher rates, so they locked in at around 2.8%. The issue is those rates aren't locked forever. When it comes time to renew, the rates might double at 5.6%. If the rates keep increasing, it might be closer to 7%. So expect a little bit of a roller coaster for Bell when management reduces guidance or adjusts their forecast. But this is a long-term play. You're here for the increasing dividends, so just keep calm and keep reinvesting your dividends. Last on the list is Smart Centers REIT, ticker symbol SRU.UN.TO. It says .UN because it is a trust, so you're a unit holder, not a shareholder, but just treat it the same way. If you watched all my videos, you're probably annoyed of me continually recommending this REIT, but I've just had good experience with it. It was one of my first investments in 2010 when I got into dividend investing. Currently trading at $27 per share, down almost 15% in 2022, they pay a monthly dividend with an annual yield of 6.79%. Being granted REIT status in Canada, they have to pay 100% of their taxable income in the form of distributions. So you'll generally see higher yields with REITs. However, since they pay out so much cash, their stock has trouble growing in comparison to other quarterly dividend paying companies. Smart REIT hasn't increased their dividends since 2020, but from 2010 to 2020, they were averaging above a 5% growth rate in dividends. So I'm confident once we pass this recession, they'll start increasing again. Also, I picked this REIT because they didn't cut their dividends compared to other Canadian retail REITs like RioCan or First Capital, who cut their dividends by 30% and 50%. We're going to ignore the PE ratio for the stock. This ratio is useless for REITs. In my course, Canadian Finance Pro, I think I have a 30-minute video just explaining the nuance of REITs and how to value or understand them because they are different than your average company. Since this is a real estate rental company, we're going to focus on cash flow. In Canada, REITs started reporting ACFO or AFFO, adjusted cash flow from operations and adjusted funds from operations. I would not look at FFO since it's not a good measure of cash, in my opinion. Their ACFO is not looking the greatest, decreasing over the last 8 quarters, sometimes not enough to cover their distributions, but I have a positive outlook over the long term. Just based on their tenant mix, we can see their top 25 tenants. What I like about REITs is being able to drive by and actually see their properties and see how busy they are. Their top tenant is Walmart. They have other consumer staples and grocery stores, which should make this REIT recession-proof in my opinion. That's it for this video. If you have room in your RSP or TFSA, these would be good purchases to shelter some tax. Keep in mind, your TFSA will have another $6,500 in room as of Jan 1, 2023. Please check out the link to my course, Canadian Finance Pro. You can get 30% off. Let me know if you have any questions and tune into the next one.